Welcome to another CEO Wisdom Pod. We have Randy Wootton with us today. He is CEO at Maxio. We're going to talk about Chargify, which is part of Maxio now, and SAS Optics, and Randy's career as a CEO. It's quite impressive. This podcast is brought to you by podpair.com if you want to start or scale a podcast. Randy, welcome to the pod. Tell me a bit more about yourself and what you're up to nowadays.
Well, thank you. It's great to connect, and I appreciate the opportunity. So to net it out, I did a short tour in the military, and then after that, I went into corporate sector in software. I've been there for about 25 years, all in software as a service. The first part of my career was in go-to-market tech, so selling tech to advertisers, marketers, agencies, and sales folks. And then 2 years ago, I made the shift into fintech. As we were chatting just a little earlier, Battery Ventures bought two companies, SaaS Optics and Chargify. One was focused more on sales-led motion. Chargify was more focused on product-led motion. They brought the two companies together in 2021. And then I joined them in 2022 when we launched the new brand Maxio. So this is my third time gig as a CEO. I've been a CEO of a public company. I've been a CEO of a private company, venture-backed by Sequoia, GGV, Lightspeed, and this is a PE backed. So I've seen it from lots of different angles. And then I've sat on a couple of boards, and so it's been a fun career to date.
So a couple of your last CEO positions at Rocket Fuel and at Percolate, you've been acquired. Both of these companies ring familiar to my brain. What lessons did you learn at both and each of these companies?
Well, first, I think Rocket Fuel being a public company, it's very hard to do a business transformation in the public eye because remember, you're there to serve the public company shareholders and investors, and it's super hard, which Rocket Fuel was doing. I was there for about 2 years, is to move from one business model, which was media sales. They were the first generation AI company. We were doing predictive analytics, like no kidding, and had invested a bunch of money there. And then we were shifting to a platform business. So we eventually sold that to private equity. And if you're a private company, you can make those pivots. I think at Percolate, similarly, I come in as a professional CEO to help articulate where the new strategy could be to help generate growth. And at Percolate, it was a shift from SMB mid-market social media into enterprise content management. And that was a transformation. We did that for about 2 years and sold it to Seismic, a sales enablement solution, one of the leaders in the market. And I stayed on as head of strategy. But the lesson learned there was it gets super clear about your ICP, your persona, and you got to focus on the new business if the old business isn't growing. So you have to segment it out. You have to be able to represent the cohorts. And then you got to be able to show the growth so that if you want to do a transaction, if you need more money, you're either going to get more money or you're going to get bought and rolled into a bigger company. So very excited about landing that technology at Seismic for the customers, the employees, and the technology. And Seismic has continued to make investments on that premise of how do you engage with content broadly across marketing and sales since the last 2 years. So similarly at Maxio, it was an integration of two companies. And so the opportunity was come in and say, okay, what was the strategy? What was the investment thesis? Are we delivering on that one integration? And it always comes down to get the platform across the finish line. And that's what we've been working on for the last 18 months.
And tell me about the intensity to running these companies and have exits in less than 2 years as a CEO. What does it require?
Well, I think part of it, the timing comes down to a little bit of combination of business performance, market dynamics. So in any of those companies, we might have gone longer. I think it's hard when you come in with a set of investors who put a bunch of money in and you're saying, hey, we need more money. And they're like, but wait, we've already put all this money in. So I think the key to success is getting aligned with investors around what an outcome needs to be, and how much money they're going to put in to support the transformation. But one of the reasons I like working at Battery is they brought two companies together. They're investing out of a $4 billion fund. We only have one investor, it's Battery. And so in my interview process, we were very, spent a bunch of time talking about, well, what are we trying to achieve? What's the platform? What are the modules we would add? And they investing out of a $4 billion fund. Do we have the capital to put into the company? And so we have been looking actively for deals to do. Still hard in this market to get people who want to sell at the price that Battery's willing to pay. But I think there's a You come in, you identify a overall strategy, you identify a growth strategy, which is some combination of organic growth. How can you go out and get more companies buying your product? And then an inorganic growth, what would you either buy as another company, or how would you partner with other folks to create that broader value prop?
Then tell me about Maxio and how you got recruited there. Like, how did these folks found out about you and why they thought you were the ideal fit as a CEO?
Well, I don't know if they thought I was the ideal fit. Maybe I was just the only one that got to the finish line. But you know what I find is to be true in each of my job searches. Um, I've I've been out. You know, the outreach is done by executive recruiters. So for CEOs, for VC and PE firms, top tier firms, they work with a set of recruiters, and those are the folks that are going out and reaching out to people. I knew at my next stage after I left Seismic, I did my earn out in December, took some time to go ski and ride my bike and be with my family. And I was like, well, you know, the next gig I want is to be outside of ad tech and martech. I wanted to show that I could take what I had learned in that industry and as a CEO in that industry and move to a different industry. And I wanted it to be a growth stage company where it's focused on the set of challenges that I'm mostly interested in, which is scaling systems, processes, and teams, scaling go-to-market, driving global segments, et cetera. And so when the recruiter called, and I wanted to work for a PE firm, and I wanted to work for a top tier firm. And so I had been doing due diligence for some of the firms, but there's this intersection of you getting to know the PE firm getting to know you, and there being a right opportunity for you to jump in. And so that was the recruiter reached out and said, hey, Battery has an opportunity, you're interested? I said, yep, absolutely. And then I had very clear criteria about what I wanted for my next adventure.
And Maxio, it's a combination of Chargify and SAS Optics. Like, seems like an interesting mix. Like, tell us precisely why it was a good idea to mix in both and merge both.
So Chargify is primarily a billing platform for SMBs focused on, as a starting point, focused on B2B SaaS. And so it offers support. Our persona is usually the developer and founder. We would be a alternative to a Stripe. And what that we allow for, though, is with the addition of SaaS Optics, which is more around sales-led motion and invoicing and revenue recognition and reporting, was that Chargify customers needed that capability. So if you talk to the head of the product of Chargify, they're like, oh, we're going to go build RevRec. And what SaaS Optic needed was the ability to support the more complicated billing models, the usage-based billing models that you find in PLG. So it was super complementary in terms of the capabilities to provide billing, financial operations, RevRec, and reporting for B2B SaaS companies from pre-revenue up to 100 million. So we have about 2,300 customers. About 50 public companies use us within their divisions. We have a couple of hundred companies that are greater than 100 million. But our sweet spot is in that 1 million to about 30 million. And those companies need both SLG motion, PLG motion. They want usage and having the revenue recognition, especially if they're have professional investors who want to know about the ARR, the gross retention, net retention, et cetera. So I think both teams were really excited about the complementary roadmaps rather than cannibalistic roadmap. It was about augmenting the and broadening the capabilities together.
And who is in charge of that deal? Like, finding both of these companies and be like, hey, maybe it'd be a good fit together, arranging the deals and aligning all parties at once.
Yeah, that was Chelsea Stoner, who is the person that sits on the board. She's the general partner, managing partner at Battery in this specific area they think about as majority-owned growth equity. And then Chelsea has had enormous experience in the office of the CFO. She had a couple of big wins with Intact, selling to Sage. I think she was in Anaplan and some other folks. So she has I think this is what the PE firms do really well, and VCs, but in general, PE firms, they develop a thesis around a specific space. So she likes to do vertical markets in the office of the CFO. And then what are the pieces you put together? I think doing the simultaneous close is really unusual. Like you just don't hear about MOEs. It's usually an acquisition where you have a much larger custom platform that you bring the smaller companies into. So this, as one guy I was talking to said, this is really the triple indie, and that you had this level of complexity where you bring two companies about the same size, so about the same number of people, about the same number of customers, about the same revenue. I mean, plus or minus a couple of mil, and you smash them together and say, okay, now you are 2 times bigger, but you haven't gone through that growth together. So it was Chelsea's vision. She sold it to SAS Optics. She brought Chargify to the table. They put the two things together. They had basically a simultaneous close, and we're off and running after that.
Did the founders of both business stay in, or did they just exit?
It's a great question. Some from both left. The CEO from SAS Optics is the one who, great guy, had sold a bunch of companies, and so he was in there to help frame the deal, and he stayed on for about 6 months, and then they started looking for a transition, and that's where I came in. And then the executive team, we have a couple of folks that were Chargify legacy and a couple of folks from SAS Optics, and then often, as I'm sure you've talked about this in some of the other podcasts, is as you're moving into that next stage of growth. So let's say the people that got you to 10 million versus the people that get you to 50 million versus the people that are going to be on the team to 100 million are sometimes those who can grow through that, and sometimes you need to get new people. So I've ended up having to hire new folks, new CFO, new CRO, new head of marketing, new head of customer success. And so I think it's one of the hard things of being a professional CEO is you got to come in and assess the talent and think about what are the capabilities you need to get to that next stage.
Yeah, it must have been pretty rocky because, yeah, not only making the deal happen, that's a wonderful part, but I guess pulling a birdie or a hole in one would be for you to stabilize everything and make sure is growing in the same direction. How hard is that, and how do you cope with all of that stress as a CEO?
One, it's hard. I think the having an understanding for how you want to think about a winning strategy is a starting point, right? Because if you can root in that strategy, then everything else plays out. The book I like is Playing to Win. It's an incredible framework. I've used it at 4 companies, and so if you get aligned with the investors and the executive team in terms of this is the strategy you're going to go after, then I talk about, and I write about this, the 7 secrets of success for CEOs. But one of the things you need to think about is the company operating system. So what are the processes, systems, and just the rhythm of business that you put into place to align behind that strategy? So you move from strategy to execution. So we build an operating plan. Each function has an operating plan. Each function has a plan on the page, which is like a 90-day plan. Each function has a scorecard. And with that, then we're able to say, hey, we're executing these different initiatives. What are the metrics that matter? If they're going sideways, how do we engage and solve? So you get people into a rhythm of the business of it's no longer going to be able to sit in a room and eat pizza and figure things out, because you got to scale through a large organization. We're about 240 people. And so, and around the world, we got people in Krakow, Poland, we got people in Argentina, we got people in the Philippines. How do you create consistent alignment from top to bottom in terms of these are our objectives, this is what our mission is, and this is what success looks like? So I think, having that playbook, people can check me out on LinkedIn. They want to chat more. I've written a bunch on it. There are other people out who talk about it as well. I think the thing primarily as a CEO is this idea of what level of altitude are you operating at? I think of the CEO as being like, my time should be spent on the things that are going to make an impact over the next 24 to 36 months. If I'm helping to solve a conversion problem on a specific deal this month, I'm over functioning through multiple levels of management through sales. Getting an executive team to be able to think at that level of abstraction and to take on those problems, the important, not urgent ones, is really one of the hard things. So that's hard. There's playbooks to do it. You do it once or twice. I think the advantage of being a third-time CEO is I have more confidence about it. I'm doing some pattern matching, and I'm aligned with the investors. How do I deal with it personally? I think you just got to really honor who you are. So, I talk about family first. You got to be aligned, with your wife, partner, and kids. Figure out what is the time and way that you're going to spend quality time with them. I think the second thing is your physical health. I work out 6, 7 days a week. people told me when I was younger that that was not going to be possible. Like, I'm not in the greatest shape, but it's the only time I have where I go ride a bike or I go lift weights or do something. And in that, it's both moving meditation and it also relieves a lot of stress. But I do think if you're a CEO in a turnaround situation, you're just signing up for a level of stress. And I used to fly jets in the Navy. I tell people, like, look, no one's dying. So like the level of stress I have now versus the level of stress I had back then, it's, very, very different. And we're all going to wake up tomorrow in our beds and be able to fight another day. So I think there is something about perspective. There's something about taking care of yourself. There's something about making sure you're managing your, mind, body, and spirit.
How do you compete with Stripe?
Yeah, so Stripe is a developer first API technology. It's the default. I mean, I think they passed $1 trillion in payments. Um, what it requires, though, well, one, they don't support complicated usage-based models. They're pretty standard out of the gate. We focus specifically on B2B SaaS, so there's something about industry specificity. And then number two, the real thing we find is that to get your pricing catalog up and introduce new pricing schemes, you really have to be a developer. You got to understand how to engage with APIs and read the SDKs. When a company gets to about 30 employees and they bring on their fractional CFO, the CFO is not going to be coding to the APIs, and the CEO probably doesn't want their developers working on a billing problem. So what we offer is both the billing and payments capability that a finance team can run, and then this growth potential where you have revenue recognition and reporting. So it's running your business versus just doing billing. And that's, people will often grow into the Maxio solution from Stripe.
What are your top goals for this year as the CEO?
Well, I think every CEO in this market context in B2B SaaS, which is going through a recession, and if people on your podcast want to read more about what's happening, they can go to our website, maxio.com, and download our Maxio Institute growth report, where we have captured we have 2,300 customers, about $15 billion in billing and invoicing, and we break it out by stage, by size, by go-to-market model, and they can see where they are and what's happening. But what you've seen is a compression in the B2B space. So I think every CEO is focused on growth. It's around, well, how much growth is reasonable within this market. I think for us, it's around what we describe as secure and expand our customers. So how do we address potential churn? How do we, with bringing two platforms together, and we've introduced the payments module, it's no longer single SKU company. We now have all this capability that our customers could take advantage of, but a lot of them just remember, hey, I'm just using you for billing, or I'm just using you for invoicing. And so it's how do you, for our 2,300 customers, make them aware of what we have and make sure that they're getting the full value out of the platform.
And as a SaaS, how do you survive in a recession, a B2B SaaS that is?
Sorry, could you say that again? How do you survive a recession?
Yeah, as a B2B SaaS.
Yeah, well, I think the number one, and I've written a little bit about this as well, is this guy, Todd Gardner, had an article on LinkedIn called the porpoise strategy. And the porpoise strategy is you actually get profitable periodically. And then when you're profitable, you can choose to make investments and go unprofitable. But controlling your own fate means getting EBITDA positive. So when I first joined, that was one of my top mandates, maybe lesson learned from both Rocket Fuel and Percolate, where the burn was way out of whack with what the revenue was you want to be in a company that can be EBITDA positive. And that just coincided with, I joined during COVID. Was no one knows what's going to happen. So make sure that you've got enough reserves to execute. Is part of the reason why I went to Battery as well, is because they got a lot of money. I didn't have to go out and raise money. I think there are a lot of B2B companies that they raised money and was told, your next raise will be 18 months, and then they changed their minds, and now it's 36 months. So I think as a B2B SaaS CEO, focusing on EBITDA, break even at least, and your cash, and understand what's going to happen there will allow you to to survive, not just survive, but thrive. What we talk about is efficient growth versus growth at all costs. The metric that we use primarily to help inform that is two. So metrics. One is the rule of 40. I think it's a really relevant rule for which is a combination of your ARR growth and your EBITDA margin. I think it's really relevant for the companies of our size, like Series C and D. It may not be as relevant for others. And then the other one, I think, Charles, is the CAC ratio. CAC ratio being how much are you spending in sales and marketing to generate $1 of ARR? A lot of people don't know that. And so they're spending a crap load of money, but they're not seeing it be efficient. And I think you need to be able to dial your go-to-market engine, tune it so that you understand input output and get super clear with your investors in this tough market where the price per keyword is going up and the CAC is going up. Like, well, how much are we going to invest to continue the growth and what's going to be the limiter? If you don't have your hands, and this is why I came to this company, I was a SaaS Optics customer at Percolate. It changed my life in terms of how I think about running a business, using the business radar to inform what we could be doing so we don't crash into the mountain. So we're, drinking our own champagne on that in terms of we use 27 metrics. We look at them every single month and what's happening every single quarter, and we dial them with investments and trim back on areas that aren't working.
Love that. What have been some of your most efficient GTM strategies from an ROI perspective this year?
Yeah, it's a great question, Charles, because we're trying to sell to CFOs, and in a B2B recession, CFOs are telling everyone else to cut back on their spending, and they too don't want to spend. And so I think it is a challenge to do the outreach. I would say the two things we've done. One is we're seeing a lot of engagement with my own podcast, SaaS Expert Voices, where I interview SaaS experts in terms of what's happening in the space, primarily focused on the office of CFO. We're finding some really good engagement, upper funnel engagement there. I don't know why. I mean, we could always use more, but I think that's a new way of offering value. The other thing that we did along that kind of content-led motion or media-led growth model is we launched this Maxio Institute report. And that's one of these where we're a system of record for $15 billion. No one else has that data on private companies. You have a bunch of people that are doing public company informed because they look at all the earnings. But what we're able to do is provide this insight. And so every quarter we're getting that out. And we have TechCrunch picked us up and some other people have picked us up. And so we want to become an authority in terms of what's happening in the private market that people will turn to us. And CFOs will want that as they build their plans, as they build their budgets, as they try to work with their CEOs to build the investment thesis. This data becomes essential. And so then we have that brand connection of Maxio is helping you to maximize your business.
How much can a CEO of your stature bring home on a yearly basis? Is it somewhere around 500K a year and 2%-ish on the cap table?
Can't tell you that. But there's all sorts of data out there in terms of, Series A, B, C company, what the CEOs earn. It's a I'll tell you this is a competitive market. So that I made a lot more money when I was a CEO of a public company, but I was the CEO of a $500 million public company. And so I've taken step downs, but have taken an increase in terms of equity, the assumption being the upside will pay off more than the flow. But it is a competitive market. They have all the data. You're gonna, as a CEO, if you think you're gonna negotiate more, you're probably not. They know exactly it's 75%, 50%. All the VCs share their data. It's almost unfair. Like you can't negotiate harder. But if you got some experience and background, you can say, look, I think I'm worth the 90% market rate, not the 25% market rate. And that just comes from if you've delivered the results. And I've done okay, but I don't have a jet. I don't have a yacht. So, I'm not the big dog on the deck, but I'm certainly working on it.
And why B2B SaaS? Why do you have a passion for that?
Yeah, it's a great question, Charles. We used to call it web-based ASP, and the thing when I got into it, this idea of an application service provider, I fundamentally was like, I didn't even know what I was getting into. I went to join some friends with a startup. They were doing this web-based application, and when I got there after business school, I was like, oh, this is transforming the way people think about software. Mark Benioff was the brilliant one who came up with software in the cloud and SaaS as a business model, transferring from capex to opex. But it made all the sense in the world to me, like this was the future of software, this business model. So I wanted to be in and around it, and have really learned a bunch over the last 20-something years.
Last question. Do you feel that ex-militaries make the best CEOs out there?
I don't think they make the best CEOs. I think one of the things they do is they bring this sense of mission orientation, investment in building leadership capabilities, accountability. In terms of the military, you are always accountable. Like when someone, this is unlike our politicians. You have a military guy run a ship aground, they get fired, they know they're going to get fired. They're going to get court-martialed. And I think this deep sense of mission and accountability to delivering on the mission and taking care of the people. You don't get paid a lot in the military. So it's all about how do you win the hearts and minds of people. I think we tend to be execution oriented as well in terms of like, here's the mission, let's go execute and be able to respond when things don't go right. Like the plan always fails as soon as you hit the beach. So you got to create a fast twitch decision-making muscle, extend your capability through your leadership team. So I think there are a lot of great military CEOs, and there are other ways you can come to it, but I do think there's an extra oomph that you get from people that have been on the front line.
Thank you so much, Randy, for the insights. Where can people find out more about you?
Well, I'm on LinkedIn, as I mentioned. I'm doing a bunch of writing there. We also have maxio.com. And if you're interested, I just started up a coaching service as part of the Hard Skills Exchange, and you can reserve time and we can chat about any of your problems around go-to-market, raising money, managing boards, etc.